Chapter 12 takes us full circle. By that I mean this is the last chapter in our course and also the chapter that focuses on the last step in the accounting cycle. We will be focusing on the three of the four major financial statements, looking at how to close the books at the end of a fiscal year or period, and to look at the optional set of entries called reversing entries. Let's start by ensuring that we understand what closing entries are and what they are not. Closing entries, first of all, are required in order to conform to at least two accounting principles: the revenue recognition principle and the expense recognition principle, also called the matching principle. And remember, these two principles indicate that revenue must be recorded in the period earned, not restricted to when cash was received, and expenses must be recorded in the period incurred, not necessarily when cash has been paid. And so, in order to ensure that we only have the revenue for a particular period and the expenses for that same period, we have to do what is called closing entries. So, what exactly is a closing entry? A closing entry is an internal entry or a set of internal entries that will cause the balance in temporary accounts to be equal to zero. Did you get that? It causes the balance in temporary accounts to be equal to zero. So closing entries will close an account, temporary accounts, so that when you begin the next period, those accounts will have zero balances. It's not the same as walking into a bank and saying, I'd like to close my account, which means that you will no longer be using that account. With closing entries at the end of the fiscal period, all we are doing is identifying the temporary accounts and making sure that the balance in each is equal to zero. So these are the accounts that will definitely have to be closed. The revenue accounts to make sure we start the next fiscal period with a zero balance. All expense accounts to again make sure that we start the next period with a zero balance. And the same thing for the drawings account. We want to start the next period with zero balances for all of these temporary accounts. So how do we do that? Well, in order to have the balance in an account equal to zero, we simply need to record the amount that is the balance in that account on the opposite side. Which means if an account has a debit balance, such as expense accounts and the drawings, then we make the balance equal to zero by crediting. If the account has a credit balance, for example, revenue accounts, then we will debit the account with the amount of the balance so that the account will then have a zero balance. Well, if we're debiting an account, what do we credit? Well, it depends on what we are closing. So if we are crediting each expense account, we are going to have to record the corresponding entry in a special account called income summary. I will show you how all of this is done as we go through the problems. We're going to be using problem 12.4b to illustrate the key concepts for this particular chapter. And this is the ledger balances. These are the ledger balances for Sheldon Company. And it says on January 31st, which is the end of the fiscal year. So at the end of the fiscal year, these are the assets, and we know assets have debit balances. These, of course, contra assets, such as the accumulated depreciation, it will have a credit balance because contra means to subtract. So the contra asset accumulated depreciation is subtracted from the related asset, which is in this case store equipment. And we have our liabilities, we have equity, and of course, liabilities and equity, they have credit balances except for the contra equity, which is the drawings account, that has a debit balance because it's subtracted from the capital. Then over here, we have our revenue, our expenses. Revenue accounts, of course, have credit balances, but contra revenue, such as sales returns, would have a debit balance. Purchases, debit balance. Purchases returned is a contra, so that would have a credit. And I'm going through these because we will need to put these amounts in the correct column of the worksheet in order to complete this problem. Once we're finished with the unadjusted trial balance columns, we will then have to make our adjustments, and then we can prepare the actual financial statements. This is the 10 column worksheet, and here we have our unadjusted trial balance. So you can see all the assets have been recorded, all the liabilities, all the equity accounts, all the revenue accounts, and the expense accounts. And I know that I did this correctly because my total debit is equal to my total credit. So now I am ready to begin recording my adjusting entries. Notice also that based on the unadjusted trial balance, we have a net profit of $7,839. Now, that is not the correct amount, most likely, because we have yet to record the adjustments. Once we record the adjustments, which would get us to the correct balances, we will then be able to determine the correct income or loss for this particular fiscal year. Let's take a quick look at the adjusting information that we need to use. The first one has to do with merchandise inventory. At the end of the year, it's $55,750. And we know that the firm is using the periodic inventory method because here you see the purchases account. So what we have to do is close out the beginning inventory and then record the new ending inventory. So right now, according to the ledger, the company is showing inventory of $55,500. We know that is not the correct amount because they told us that it should be $55,750. So what we need to do is make that zero and then record the new balance. So the first thing I do is close the beginning balance by making a credit for the same amount. So notice that there's a debit balance, which is correct because it's an asset. And so to close it, I record the same amount on the credit side. Notice that it shows a zero here because we essentially have closed the account. So my credit is going to be to the inventory account, and then my corresponding debit is to a special temporary account called income summary. This account has one purpose, and that is to facilitate the closing of the temporary account. So we literally create a temporary account that we use to close out the other temporary accounts, and when we are finished, we close out that special temporary account as well. So to close out the beginning inventory, we credited inventory and we debited the income summary. The next step, item B, is to record the new ending inventory, which is 55,750. So notice I'm debiting here. So it shows now the new balance. So you can see what happens when you close an account by crediting the same amount. It was zero. And now we debit for the new amount, and you can see that that is now the balance in my inventory account. So what is my credit for this debit? Well, it would go to the same income summary. And so we debited inventory with the ending inventory and we credit income summary. Please note that while it's not the approach for this particular problem, in reality, we could have simply recorded the difference between these two amounts. So instead of debiting 55,750 and crediting 55,500, I could simply have made a debit here for 250 and a credit here for 250. So instead of making 4 entries, I could have made just 250 debit and 250 credit. If it were a case where the ending inventory was less than the beginning, then I would have credited the difference to inventory and debited the same amount to income summary. Again, following the approach that is used in your book, we close out the beginning and we record the new ending inventory. So now in the adjusted trial balance, what you see here for the inventory is the new ending balance for inventory. Since you are familiar with adjusting entries from chapter 11 and from chapters 4 and 5, I am quickly going to go through these and then just show you what the entries are. So we did A and B, which is the closing out the beginning and recording the ending. The third adjusting entry is regarding insurance that has expired. So we have used 1,285. And so in the ledger right now, there is an amount for insurance which should be at least this amount. So it's saying whatever we had, this is what we have used. So this is now the expense amount. So we're going to take this from our insurance account and put it in the expense account. Then we have depreciation for the year, 5,482. We do not know what method of depreciation was being used, but regardless, the entries are the same. We're going to debit depreciation expense and credit accumulated depreciation. Here we have accrued wages, January 31st. So between the end of the month and the last pay period, or from the last pay period to the end of the month, the employees continue to work, and of course they are earning their wages, but they're not going to be paid until sometime in February. And so because of the matching principle, we have to record the amount that was incurred during January so that we have the correct expenses for wages. And the last one is supplies used during the year, 1,503. So again, we have supplies that we had bought, and this is what was used. So we're going to have to take it away from the asset supplies and record it as an expense called supplies expense. So here are the entries recorded in the adjustments column of the worksheet. You can see for C, we decreased this asset by 1285, the amount used. So this credit decreases this debit. So we have left 1,795, and that represents insurance that we have not yet used. So we're going to bring that over to the next fiscal period. And of course, we credited the asset and we debited the expense. Remember, when you are recording adjusting entries, one account has to be an income statement account and the other one has to be a balance sheet account, and you never ever use the cash account as one of the accounts for adjusting entry because we are not recording transactions, we are recording internal events that will ensure compliance with the revenue recognition principle and the expense or matching principle. Look at what has happened to the profit. It actually has now changed and it's a loss of 1,737. Now, again, this does not mean that adjusting entries will cause you to lose money, but what it does tell us is that by making the adjustments, we changed the information that was being reported. So rather than them showing a profit for the year, they are now going to show or report a loss for the year. So this is my adjusted trial balance. These balances are used to prepare the financial statements. And then we have the income statement. So I know when I prepare my income statement, I should end up with a loss of 1,737. And these are the long-term or permanent accounts, which simply means that these are the balances that are going to go over into the next fiscal period. So all of the temporary accounts, and they are the ones that would be in your income statement, are going to be closed, and we're going to take the balance sheet accounts over into the next fiscal period. Since we are satisfied with what we did in the worksheet, that special tool that we use as accountants, everything looks fine, we can now prepare the actual financial statements. And so we prepare the first of the four major financial statements, which is the income statement, which tells us the financial performance or how the firm performed over a specified interval. In this case, it's for the year ended January 31st, 20x1. You see the revenue, subtract the returns, we have net, and we take our beginning inventory, add the purchases, subtract the returns and discounts, add the freight, and that would give us what is called goods available for sale. And then we subtract the ending inventory and we get what is called cost of goods sold. So they sold inventory for a net of 225, but the cost to the company was 173,299. And so the difference between the net sales and the cost of goods sold gives us gross profit. This is the profit that should be sufficient to pay for all of the operating expenses. So we take all the expenses, the wages, the advertising, and so on, we add them and we subtract from the gross profit. So the total of these is 53,439. So we have a loss. Please note that when you're entering the information into your template, enter them as absolute dollar amounts, and the software, the spreadsheet, will automatically do the addition for you. Do not enter these as negatives because then it's going to end up giving you the wrong answer. So enter these as absolute dollar amounts, they get added, and this total is going to be subtracted, and you will get, in this case, a net loss. This is probably the first time that one of these show me problems has a loss, but that's possible for a business to have a loss. We move on to the second major financial statement, which is the statement of owner's equity. And this one is also for a specified interval. In this case, it's for a year. We start with the capital of the owner or owners at the beginning of the year. We add the profit, or in this case, we subtract the loss. and we subtract the drawings, and so this is the ending balance for the owner's capital or equity account that will now be reported in the balance sheet. Please note, we do not show the beginning equity in the balance sheet. We show the ending. So this is what is going to be brought over to the balance sheet. So you can see that the profit or loss links us to the statement of owner's equity, and the statement of owner's equity is going to link us to the balance sheet. Here is the third of our major financial statements. This is the balance sheet. And unlike the other two that are for intervals, this is for a specific date. So on January 31st, what were the assets or resources of the business, and what were the claims against those resources? Claims by outsiders, claims by the owner. So we take all the balances from the balance sheet columns of the worksheet. We take the cash, the receivables, the inventory. Notice this is the ending amount because we closed out the beginning amount. The balance in the store supplies, the prepaid insurance, we add those, we get what is called current assets. What are these? These are assets that are supposed to be used to pay current liabilities. So these are assets that are expected to be used up or converted into cash within the next 12 months or the operating cycle, whichever is longer. Then we have our long-term or fixed assets. You can see here we have the store equipment, the original cost, subtract the accumulated depreciation. This is the book value. This is not the selling price of the asset. This is simply the value of the store equipment on the books of Sheldon Company on January 31st, 20X1. They could sell it for more than this. They may be able to sell it for less, but this is the value on the books based on the estimated amount that we have depreciated so far. Total assets we have here, and this should now be equal to total liabilities plus total equity. So we take the accounts payable, the wages payable. These are the only liabilities, so current liability. These are debts that are supposed to be paid from your current assets. In other words, these are obligations that are supposed to be paid within the next 12 months or operating cycle. The final piece here is the equity, and notice that this balance here is brought over from the ending balance in the statement of owner's equity. So total assets equals total liability plus total equity. This is not a required part of the assignment, but I just thought I would show you a part of the fourth major financial statement, which is the statement of cash flow. And it shows you the inflow and outflow of cash, which is broken down into three major areas: operating activities, investing activities, and financing activities. If you are interested in knowing how I arrived at these numbers, then watch the bonus video that I will share after we have started working on this chapter 12 assignment. The other thing that we can do, or one of the other things that we can do with these financial statements, is we can calculate what are called financial ratios. These are calculations that show us the relationship between at least two different values. And one of those ratios is called the liquidity ratio, which measures how quickly, how well the firm can meet its current or short-term obligations. It's called the current ratio, but the broad liquidity ratio, which includes the current ratio, measures how liquid, the company is, how well they're able to meet their obligations as they come due. So to calculate this particular liquidity ratio, the current ratio, you take your current assets. You can see we have them calculated here, 89,145, and you divide by the current liabilities, which of course is given here as 15,956. So notice I'm using current liabilities, not long-term liabilities, just the current. So 89 divided by 15.9 gives us 5.59. What does this mean? This means, in simple terms, that for every $1 of current liability, the firm has $5.59 in current assets. So as a general rule, you would like for this to be 2 or greater. Of course, you will learn if you do financial statement analysis that it can be too large and it's indicating another kind of problem. But in general, you want this to be greater than 2. So if it's 2 or more, then of course it means that you are able to meet, you should be able to meet your obligations as they come due. Someone who has done analysis of ratios will tell you it doesn't necessarily mean that, because if the majority of the assets are, let's say, inventory, then clearly you would have to try and sell the inventory before you can get the cash that you can then use to pay the liabilities. But it gives you some indication of the firm's ability to meet its obligations. Another way of measuring that is by calculating what I refer to as the absolute measure of liquidity. It's called the net working capital. And you know, whenever you see the word net, it means that you're finding the difference between at least two numbers. So the working capital would be all of these working assets, which are your current assets, minus your current liabilities. And so to get the net working capital, you take the current assets, and instead of dividing as we did for the current ratio, we are going to subtract. So same two numbers, but now we're subtracting one from the other, and it tells us that if we were to pay off all of our current liabilities, we would have $73,000 left over to do other things in the business. I think I can quickly go through this section of the assignment. These are the adjusting entries that were taken from the adjustment columns of the worksheet, and we are literally putting them in journal form so that they can be posted to the general ledger to update the account. So like we did, we debited the income summary with the amount of the beginning inventory, and we credited inventory. So that's all we're doing here. So these entries are the same ones that were in the adjustments column of the worksheet, but we had to record them, journalize them, and then post in order to update the ledger so that the balances match the ones that appear in the adjusted trial balance columns. We focus then on the next major concept in chapter 12, which is closing entries. And remember, closing entries are done to make the balance in temporary accounts equal to 0. So every account that's temporary that has a credit balance, we debit each one, and we debit each one, and we credit the total to, again, income summary. Recall that this is the temporary account used to facilitate the closing. I'll show you that we don't need it, but to follow the approach used in your textbook, this would be step 1. Step 2 is to close out all of your temporary accounts that have debit balances. So if they have a debit balance, to close, I need to credit. So each of these accounts would be credited, and by crediting, the balance would then be made equal to 0. So we credit each of these and we debit the total, the sum of these, to the income summary. So now I have a credit here and a debit, and the income summary has done its job, and so we need to close it. So to close it, I need to see which side is larger, and I will make the entry on the opposite side. So in this case, I am crediting the income summary with 1737 and debiting the capital account. This should look familiar because this is the loss that we had reported on the income statement. So when you have a loss, it decreases capital, which is what this is indicating, right? We're debiting the capital account, and since the normal balance for capital is a credit, by debiting, I'm decreasing the balance. And that's correct because it's a loss. If it were a net income, then it means that the credit side would have been larger than the debit side, and so I would have had to debit the income summary and credit the capital account. So this entry, step number 3, is dependent on whether we have a profit or a loss. So it's a loss, so I debit capital, credit income summary. This is what the income summary account looks like after we have made all of those entries. See the first entry that we made when we were closing out the beginning inventory? We credited the inventory and debited income summary. Then we recorded the ending inventory, so we debited inventory and credited income summary. And then we made the entry to close out the accounts with credit balances and to close out the account with debit balances. And then when we look at the two sides, we saw that the debit side was larger, is 294.29, and so we had to credit the income summary with the difference, which is the loss, and now the two sides are the same. So this account, because it has a zero balance, is essentially closed because A, it's temporary, and B, the balance is zero. Step 4 in closing out the books is to close out the drawings account, which of course, as you remember, is another temporary account that has a debit balance. So to make it equal to zero, we credit the amount that's in the account. So this account would now have a zero balance, and we debit the capital account. So notice that the capital account is going to be debited in this case twice, once with the loss and once with the drawing. So the total debit there is $37,737. An alternative to the 4-step approach to closing the books that I shared with you is what I refer to as the 1-step. Again, I am not asking you to do it this way. I'm simply sharing with you an alternative. So whereas everyone will know one way, you now will know a second way. And you don't need another temporary account in order to use this approach. Think about it. If we're debiting each account that has a credit balance, as we do here, and then we're crediting each account that has a debit balance to make it zero, then let's just do that, right? So we made all these debits because we want to close out these accounts that have credit balances. And then we made these credits because we want to close out each of the temporary account that has a debit balance. When you're finished, the two columns will not be equal. They shouldn't unless you had zero profit or zero loss. But in this case, it's not equal because we have a loss. Notice this number here. This is what I am debiting to capital. This should look familiar because $37,737 is in fact the total amount debited to the capital account. So with this approach, you just make one entry. You debit each credit balance temporary account with a credit balance, and you credit each temporary account that has a debit balance, And then the difference between the two is going to be debited or credited to capital. The other thing I would like to share is regarding reversing entries. Reversing entries are optional. This is a practice that is used by some businesses where accounts that are normally expenses, but they have to be recorded as liabilities because of the timing of the closure of the books, they are reversed. The same thing would be done if we had any item that would normally be revenue, say unearned, we would reverse. But it's completely optional. So in this particular problem, we had one such account, the wages payable. Recall that we recorded a debit to expense for the expenses that occurred in the month of January, but will not be paid until the following period. So we are reversing that, taking it out of the payable and crediting it to the expense. And what this does is by crediting the expense account now, when we debit the expense account, the wages expense account, with the total wages for, let's say, the middle of January into the middle of February, this credit will offset the total amount of expense that we record for wages, and so we would have the correct wage amount for the month, for the period in February. It's completely optional. A lot of businesses do not use this, but it was mentioned, so I thought I would at least provide you with some insights. So the last thing I wanted to share with you is the post-close trial balance. There are some people who suggest that accountants have OCD because they're constantly going back and checking, making sure everything is correct. Well, that may be true about OCD, I don't know, but this is an attempt to ensure that the accounts are accurate, that the ledger is in balance. And so the post close means after closing. These balances are the ones that were not closed. So these should be your assets, your liability, and your equity accounts. And so notice that you have the cash, receivables, the inventory, and so on. All of these are your permanent. I prefer to refer to them as non-temporary, but these are the ones that are not closed at the end of the period. They are brought over into the next fiscal period. And so you can see again, total debits equal total credits. And so we can confidently begin February knowing that we have the correct balances in the ledger. I hope you found this summary and show me problem video to be helpful. You may contact me if you have any questions.